Sorry to drag you away from your coffees. Hope the jet lag is not hitting too hard now. But the next session will keep you engaged as I invite Mr. George Herbert Joseph, the CIO and CEO of Equities at ASK Investment Managers, and Mr. Saurabh Patwa, Head of Equities Research at ASK, on the stage. George joined ASK about 4 months back and will play a key role in fulfilling Sunil's vision of ASK shared earlier. George is known for his stock-picking abilities, his long-term value investing approach, and ability to scale up investment platforms. Prior to joining us, George was the CIO at BlackRock Asset Management and played a key role in putting the India joint venture together. With over 2 decades of experience in equities and capital markets, he has led investment and strategy at ICICI Prudential PMS and ITI Asset Management in the past, managing about $2 billion in equity assets. Saurabh also joined ASK about 3 months back to head the research team and brings with him over 18 years of experience in the equity markets. Prior to joining ASK, Saurabh was the head of research and portfolio manager at Quest Investments and also part of the investment committee. He has spent over 13 years at HDFC Asset Management in the equity research and strategy division. I request Samir to lead the discussion on Indian capital markets.
Thanks, Gaurav. So we're not saving the best for the last. This is the best indeed. I mean, we had to bring the smartest people. So if the smartest people were coming together, then they needed someone like me next to them, which makes them look even smarter than they are, right? But we promised to make this a nice session. We got one more. We're going to let you go. And after that, I promise you, you're not going to be listening to us. We're going to party after that. This is monsoon season, right? Some of you guys know we were talking about that. Indian markets can sometimes feel like Indian monsoons. Everyone knows they're coming. Nobody knows exactly when, and forecasts are often wrong. Now, luckily, we have someone with us who is much better in giving outlook than the weather department. All right, so please welcome George and Saurabh for a conversation that hopefully will be insightful for everyone. George, let's start with you. 35 years in the market, you've seen Indian markets go through certain changes, certain multiple cycles. Where are we today? How does the next phase look like? Does it excite you?
Thanks, Samir, and warm welcome to all of you. And thank you so much for the patient hearing. That a lot of good sessions already passed by. When I look at the markets from the last 35 years point of view, we have gone through various cycles. So the memory, if I'm right, 1990 to 2000, if I divide into 3 decades and, half a decade, the first decade was, TMT boom, technology, media, telecom boom. That started with the 1991, the economy opening up, the liberalization coming in with the Mr. Manmohan Singh budget, dream budget. And 1992, there was a scam-related fall in the market. Then, the next 9 years, we saw a global rally, which was a technology, media, telecom rally, and that concluded with the dot-com bust in 2000. Then we saw a different cycle emerging. You saw infrastructure sector doing exceedingly well. For commodities, infrastructure-related companies, capital goods companies, engineering, and real estate, and some of the public sector banks doing very well, which are all interconnected in some way or the other, which was coinciding with the global growth also. China was growing at 10% CAGR in GDP, and India 8-9%. Europe and US also was growing at that point in time. So that was the next decade, which marked the end, with the global financial crisis hitting in 2008. And then, a new segment of the market started doing very well, and we call it as a consumption theme. So consumer-related businesses did very well in the next decade from 2010 to 20. So when I look at from each and every decadal point of view, it's a structurally very different set of companies start doing well and different set of sectors doing well. And 2020 marked the COVID crisis. Post that, we are seeing again the infrastructure-oriented sectors start doing well. So if you see the last 5 years, the best of the best sector performance came from commodities, engineering and capital goods companies, utilities, as well as real estate. So it's a decadal shift which started in 2020, according to me. It coincided with US interest rates bottoming out in March 2020, which is a 40-year rates and bear cycle in rates, which bottomed out in 2020 March, and then a new sector theme emerging, which is more of inflationary sectors start doing well. So we are in that decade where the inflation is sticky in US, global inflation is sticky, global interest rates are sticky. This is where probably India also seeing the sectoral performance mostly in sync with the commodities, engineering, and so on and so forth. We see that that is the decade we are in, and that is the business cycle. I am very positive about.
So you're talking about sectors. Saurabh, let me bring you in. You agree with George? If yes, which are the sectors that excite you? And your thoughts on that would be interesting.
So the way I
Just hold it closer.
okay, is that better? Yeah.
Yeah.
So yeah, I agree with George. See, the way I look at it is I would bucket into few themes in general. One of the best theme which we believe in, which will work in India specifically, is domestical cyclicals. If you see within that, there would be like something like in domestic auto OEMs. The cement companies, the cement industry has gone through a lot of consolidation in the last few years. The industry has become more consolidated, now it has gone through a series of merger and acquisition between the larger players. And now we're seeing that with a lot of infra push coming in, from the government push, the real estate cycle doing well. The cement sector is going expected to see better profitability as we move forward. Similarly, auto OEMs, there has been a recent push by the government to increase consumption. If you see, there has been income tax rate slabs moving up. Now the GST is clearly benefiting the auto OEMs, especially on the two-wheeler side, which were facing the affordability issue to some extent. With all these behind, I think these are the sectors which will do really well. Even on the real estate cycle, as George highlighted, the real estate cycle is and even as we saw in the earlier discussions since morning, real estate cycle in India has revived post-COVID and continue to do well. This is within that, the residential part continues to do even better, because the decade between 2010 to 20 saw a lot of delays in a lot of projects, which started getting delivered during COVID and so on. So that is one part. Secondly, the domestic discretionary consumption in India has been, as India's per capita income continues to increase, the vision with Indian government has for 2047 India as a developed nation, a large part of it will be driven by the consumption boom across the country into various sectors. Within that, you will see the color of consumption is changing from a previous decade or so, which was more towards basic needs of consumer staples, etc. The penetration there have reached materially higher. However, and the consumption pattern is changing in terms of people are now aware about more on travel. So airlines are doing well, hotels are doing well, which these historically were looked as more cyclical. Now they have improved, and the consumption pattern is getting towards them. Similarly, if you see, Indian consumer is now post-COVID especially have gotten more inclined towards better healthcare needs. So the hospitals are doing really well. And there is one interesting aspect to it. See, if you see, this is the first time in last 75 years since independence, people above 40 are having the highest per capita. Historically, the earlier generations, they were just trying to cope up. But this is the time when the people above 40 to 65 are doing really well. And if you see next 15 years, the pool will increasingly increase even more. So the discretionary spending in all three areas which I mentioned will continue to do very well. Similarly, then if you stack up with the credit, which is the large part of our index as well, which is the banks, banks with with the people having more confidence in their income will have the ability to generate, will ability to borrow more, and banks will also have a better ability to lend. A combination of this should lead to a higher credit growth. And thankfully, we are in the valuation terms also, banks are actually at a cyclically low, especially the larger private banks one. So all these three sectors, we are very positive.
Well, you mentioned hospitals are doing well. I think Amit Dixit told you what Blackstone has done with regards to being one of the largest operator hospitals. So, echo what you're saying. Uh, George, in the context of market evolution, right, and today's economy, both the size and the makeup, how does this filter down into the portfolio construction? Has that evolved? Or how it's changing, especially with the dynamism of the markets today?
So, when I started my career, I used to think about stock picking is the most important element in, generating alpha. When we construct a portfolio, pick the best managements, best balance sheets, looking at the profitability growth and also understanding the opportunity pool, opportunity size of that sector. All those things were the most important aspect. Over a period of time, I started realizing, especially 2008 debacle, when you saw the large cap index falling by 67%, mid cap and small cap index falling more than 75%. It suggested that you need to be more careful about the allocation part, and the allocation has over a period of time has evolved also. If you see, in 1990s when I started investing, that's the time where there was no internet, there was no mobile phones. Now we are more well connected to the world. So when something happens, Donald Trump tweets, there are changes in the markets, and it affects India also. That is a nature of the market we are in. So significant global reliance, and especially when we are an exporter, it has its own impact. So multiple reasons on which we need to be analyzing which asset class has to be there as a part of your portfolio. If at all you're a multi-asset fund manager, so you need to have a framework to construct the portfolio accordingly. So that is something which has become an integral part of my investing style or thesis. Second part is, once you decide, I want to be in equity, you need to think about in which market cap segment I need to be present. Because, this was nowhere in my mind, till 2000, late 2000s, to think about, whether I need to be in large cap segment, mid cap or small cap. If you see the last few years, especially in the last decade, the small cap segment has swelled in terms of the AUM from the mutual funds. And therefore, on the way up, it acts as a big trigger for the value unlocking. But at the same time, on the way down, it can act as a spiraling down effect also. So as a fund manager, keeping the lifeline is important. And for the client, keeping the lifeline is important. That's where this market cap allocation comes into the picture. So that also we have put in, even at ASK, as an integral part of our investment decision making. Third comes to the sectoral or thematic allocation. So when you heard Mr. Amit Dixit spoke about, or when we were discussing with Mr. Kamath, also the discussion was around selecting the sector right and selecting the theme right. Data centers. We spoke about various aspects of it. That is very critical even before start hunting. You need to plan your hunting also, where to hunt and how to hunt. You need to have the method to the madness. So that again, theme or sector selection, is very important. So when you mix up with the cycles and see that, which cycle after a big crash is, evolving, and we realize that, in conjunction with that, we look at what sectors and themes can work, because every time after a big crash, you see different themes and different sectors emerging. And especially as I mentioned, post 2020, the entire cyclical sectors in India have started doing very well. So that became, again, an important part of the entire decision-making process. So lastly, the portfolio construction obviously need a very strong bottom-up research process, which is also very important for picking the right winners and picking the right managements, quality of the promoters, especially in Indian context when you're betting on family-owned businesses. All these became very important. So all these four are part of the decision-making quadrants, which I call it, the four quadrants in which we hunt for ideas.
When you said when Mr. Trump tweets, most of the time I'm asleep. But when I read his tweet, I lose my sleep. So I think it's probably the same for most of us. But jokes apart, Saurabh, as George said, in today's world where data and information is so readily available, right? How has your research process adapted to that? How do you siphon dirty data vis-a-vis high quality data? I mean, we are overloaded with data today. So how do you filter that in the research process? That would be useful for the audience.
Sure. You're right when you say that there is a lot of data which is available. And when I hear from people who've been in markets even before I started working, getting annual report itself was a task for a lot of the people. So from that to now, where we like the AI can just interpret or make a summary of the annual reports, call transcript, etc. A lot of information is readily available. However, what is not available is the interpretation of that, and that's where the key of equity research lies in. How AI helps us, and the way we have also integrated it is it's aggregation of data, segregation of data, accumulating a lot of data and try to get insight on this. So this AI or the excess data democratization of the way we would want to look at it has made the excess of data. So now the focus has to shift from insightful interpretation of that data. What we mean is, like, so when we invest in any equity, investors essentially doing two things, has to do two things. One is to understand the business and understand the and decide on the right management. So both of these require insights and is understanding of cycles, understanding of those businesses, which is what the focus now at our end is. The way we have incorporated this into the research is we do plant visits. This is something which AI or data cannot do. That gives insight. Meeting management, trying to understand the business from their perspective, and on top of that, meeting experts of that sector or of that business, and incorporating a judgmental view on basis all of these things. See, eventually, the fund manager or the analyst has to have his own conviction. To invest for a long term, you need to have convinced with the narrative or the investment thesis which you have built in. That is what the core job is, and that's what we are trying to build in ASK.
So let's dig a little deeper. Either one of you can answer this. Because this question keeps on coming. We see this particular point being mentioning. And then, of course, we have challenges with regards to tariffs, which are also changing the narrative significantly. Are Indian companies really benefiting from the supply chain diversification? And everyone knows about Apple. So that's one example that everyone is aware. But talk us through some other sectors. Where is this diversification, this China plus strategy? Is it really at work? Are we seeing tangible changes coming in? And with the tariffs coming in, is that going to put a stop, or is it going to be a stumbling block in any manner in the long run? So your thoughts on this, either one of you would be useful.
So if you look at the semiconductor industry, there are companies which are betting on the entire supply chain improvement, which can be done in partnerships or otherwise by themselves, setting up some of the very core requirements, what they are visualizing as the opportunity. So just to take a case in point as an example, the company called CG Power, it's a management, on public, they have mentioned that, this is how they are going to change their directions and, make it. It's a very credible group, coming up with these statements and, which is aligned with some of the government policies, which makes the argument much more credible. And again, excellent execution history from those groups make us believe that this is something which they are seeing as an opportunity, and which come into reality. So we are seeing the similar case with many engineering companies, where so electronic manufacturing service, which has emerged as one of the biggest winner in this space, where you see the PLI benefits which government is giving is adding to the boost. But at the same time, there are many sectors like this which is emerging as winners. So China plus one in different formats and different shape and formats, it's happening. But whether, and PLI as a scheme is something which government has announced some time back, which has added, we have seen job creation there, almost 12 lakh jobs being created, and more and more companies adopting to it and getting the benefits. So it is a long-term push required, and also in the capex stories, where we are seeing there are benefits of these China plus one strategies visible. Renewables, various areas, we are seeing, there is more and more interest coming in and companies participating.
So guys, when you hear me, my team talk about this is not an urban myth. It is really happening. So important that it gets amplified. Let's talk a little bit about valuations, right? Always a concern. And we did hear Amit saying, if you want India to be cheap, all the best. Keep on waiting. But at current valuation, given the earning growth expectations, is there a mismatch, or are we fairly valued? What are your thoughts on this right now?
So broadly, as Amit was explaining, and it was perfectly fine, when he spoke about the Nifty 50, which is the large cap index, which is at a 10-year average, and which is looking reasonably attractive. And when you drill down, there are many companies in the large cap space looking extremely attractive. As Saurabh also was highlighting, some of the banking sector stocks, which were the darlings of the previous decade, are trading at a 5-year trough valuations for various reasons. The good retail franchise, not a fly-by-night, and can do very well in the marketplace in the coming years. We see them available at a ridiculously cheap valuation. So there are pockets of opportunities, but broadly, the large cap index at a 10-year average valuation, which looks very reasonable to us. But when we look at mid cap and small cap segment, that is where, for various reasons, the froth is there to a certain extent. And that is we are talking about only 30% of the market, right? And 70% of the market predominantly is in the large cap space. And this 30% of the market, it is a 2-decade high valuation. Main reason which I can think of is the SIP book, the systematic investment plan, the money which is coming in monthly, $3 billion into the mutual funds, 70% of it is diverted into the mid and small cap space. So that is why that froth in the valuation is visible. But yet at the same time, what we are seeing is there is a significant earnings rebound possibility in the next half onwards, and which can potentially mean many of these overvaluation will automatically normalize if the earnings growth comes through. So this is the nature of the market. We don't know whether it warrants a correction. Sometimes when we see these kind of 2-decadal high valuation in small and mid cap, it poses a risk of a big drawdown, which we saw in October 2024 onwards till Feb 2025. Similar kind of drawdown is possible, but if at all it stays there for a year, probably the earnings growth will automatically start normalizing the valuation. So I am extremely positive at this point in time on the large cap space and less positive on the mid and small cap. But all through my life, I've been a mid and small cap guy. So you take with that, that insight.
So for the benefit of all the audience over here, because I know some of you who've met us before, we've shared this with you. You've heard this word again and again, SIP, S-I-P, Systematic Investment Plan. What is it exactly? So I'll just spell it out because some of these acronyms get used quite extensively. This is a regular saving plan, as we would know. The gentleman before us who was talking about Paytm, if you remember what he said, they are now offering ability for investors to put in on a monthly basis, daily basis, he said, something as less as 21 rupees. That is 30 cents. 30 cents, guys. So this is the amount of this money when aggregated on a monthly basis. These are the mobs and pops in India who are saving pennies and dollars on a monthly basis and investing that in a mutual fund. That's what a regular saving plan is. You fix an amount, whether it's $20, $30, $100, and then you continue contributing that amount on a monthly basis, on an yearly basis, dollar cost averaging, essentially. That's what SIP is in the Indian context. That amount today adds up to about 35 to 40 billion dollars every year. That's the small sum. So that's the power of inclusion. All that we spoke about, technology, we spoke about India stacking, we spoke about the jam trinity. All that has primarily ensured inclusion of the common man who now has access to equity markets and is making small investments. But given the size of Indian market, and we're still scratching the surface, given the size of that Indian market, that amount accumulates to about 35 to 40 billion dollars a year. That's what that number is. So hopefully, when you hear the word again, SIP, that's what it means, all right? And that's exactly what, again, we had George alluding to for everyone's benefit. Saurabh, given he shared his thoughts on small and mid cap, sector-wise, your personal preferences in terms of which sector a global investor should be looking at, one, or rather which is exciting more than allocating immediately. And number two, I'll also like to hear your thoughts on how do you evaluate the traditional versus the new age sector? So manufacturers, renewables, and technology versus, say, banking on FMCG. So some thoughts around that would be very good.
Yeah. So I'll take the second part first.
Yeah.
So essentially, see, so if you divide India into the opportunities into two parts, see, most of these new age businesses are around consumer and fintechs. So fintechs is something which we just discussed. Especially on the consumer side, you would have seen these businesses have evolved meaningfully in India. Some of these businesses got replicated from the global peers, say something like a food delivery. But the execution in India has been exceptionally well. The Indian consumers, even in tier 2, 3, 4 cities, have also taken these businesses really well. The acceptance has been good, and they are now actually they are genuinely making money in that businesses. Another businesses which is like adoption of quick commerce, which is something which is globally not done well, which has worked well in India, is given one of the key reason is it brings the convenience. The Indian cities are more denser, and there is a labor arbitrage which is there. So which makes India very different from the global context. These businesses have to look, if you have to look at these businesses, the opportunity size is huge. The whole, even at the scale which they're doubling their revenue every year actually. What they would call the GOV, which is gross order value, they're doubling every year in last 2-3 years. These balance sheets of these businesses is very strong. The way one has to look at it is has to understand the opportunity size first, and see the profit pool which can be possible. And there are various ways these companies have demonstrated they can monetize it. It's like something which is not available in a genuine business, say like a modern retail versus a quick commerce. Modern retail may not have a large avenue to make money through ad, whereas quick commerce has, because the conversion of ad to order is meaningfully higher. So the profit pool has to be looked from a relatively distant proportion However, the key difference also here is some of these platform businesses I have actually negative working capital. So the cash flow is very different. The way I would look at it, these businesses, say like from think about it, these new age businesses from manufacturing businesses who just started. Say like a cement company when it started, for the first few years when the capex is till the time the adequate revenue in terms of utilization is not generated, they will not make money. But that doesn't mean that someone should not go and actually invest in those businesses, right? So this is one way we look at it. Compared to that, when we look at the traditional businesses where the growth will be very may not be meaningfully higher, that's where we have to look at the how, and when you compare them with their global peers, they may optically look expensive. But when you dig deeper, you look at their ROEs, they look at their ROCs, they're meaningfully higher. And ABB India will have a much higher ABB ROC versus ABB Global. Because of the fact that in the India, the growth is higher, and the opportunity size is big. The formalization, shift from unorganized to organized, all of this is happening at the time when the penetration itself is low in many of these categories. So you have to have look at these businesses from this perspective. Similarly, when you look at banks, the ROEs of Indian banks and ROEs of Indian bank compared to the global ROA is materially higher. Again, because the NIMs are higher. So you have to look these businesses from these perspective. That's how I would look at it.
So again, some of these words are unique to India because is everyone familiar with quick commerce? I don't think so, because in Europe, we are still getting used to e-commerce. Quick commerce is still far away. So, again, a bit of education. Let me tell you what quick commerce is. Because in Singapore, we don't have it. Let's go back to the first session that Sunil did. And if you remember, he gave an example of Unilever. When they came to India many years ago, they were selling whatever. They were selling sugar at big packets, 1 kg of sugar, or they were selling shampoo in 1 liter bottles. Indians are notoriously frugal. Notoriously. They want value and they don't want to overspend on something in the long run. As a result of which, Unilever had to introduce, they don't want to buy 1 liter shampoo, as you would go and buy in Costco in America and in these places. They want to buy 10 ml of a sachet, which you can use only once for shampoo. And the logic will be, I don't need to shampoo every day. I'll shampoo twice a week. So 2 sachets is enough. I don't need to buy a 1 liter bottle. So that's the general market sentiment. On the backdrop of this, if you go to the supermarket anywhere, either in Europe and in Singapore, we end up buying a bag of potatoes, right? Typically 250 grams, half a kilo, 1 kilo, that's what we will buy. Quick commerce is the ability to say, I want 1 potato, 1. And there are services which will deliver it within 10 minutes. It's very unique to India. You can choose to have, not the best example to give you, but 1 stick of cigarette. Only 1 stick. You don't want to buy a whole packet. I want 1 stick, and that stick comes to you within, is it 10 minutes?
So at my place, it comes in 6 minutes.
So these are startups. It's called, I think, Blinkit is one, and the other one is?
Swiggy. And there's something called Zepto.
So when I speak to my friends, colleagues, family members over here, and I say, okay, if I'm visiting here, and I say, I think we don't have it, or just Swiggy it. So as I think Nikhil was saying, it's become a verb. Swiggy it, Blinkit it. Blinkit it in the sense you can get whatever you want. You can get 1 tomato. You can get 1 potato. You can probably get, I don't know if it's 2 loaves of bread, but it's just absurd. And it comes within 6 to 7 minutes. So that's quick commerce. It doesn't exist anywhere else in the world. Quinton, you've seen that in South Africa? No chance. As I said, world is catching up in e-commerce. India has moved to quick commerce. And that's what it is. So to give you context of what we are talking of. And these are the companies. So brings me back to a question. Everyone talks about some of these unicorns, some of these new age companies. How do you play them? Because not everyone's listed. What are the ways to access these companies? How do you look at them? Are all these companies investable? Are all these companies exciting? How do you go through them? And how can our portfolios at some point of time start getting exposure to these kind of new age companies?
So this needs is a different skill set to look at some of the names, which are trading at exorbitantly. When if you look at the traditional way of analyzing these companies, you feel that these are all trading at ridiculously overvalued zone. But the companies are literally doubling their revenue and they're doubling their profits. But they're burning the profits to make a different line of business side by side. So the platform companies, some of the platform companies are already existing, which are, say for example, if you want to play the capital market theme, right? And you know that the markets are going to compound at least 11 to 15%, give or take, every year from here for next 15 years, 20 years. If that is the view that you are taking, the markets, from $5.4 trillion, it compounds at 12 to 15% compounding, you believe in, then there are companies like CDSL, which is more of a depository company. If you want to buy a stock in your account and that account is maintained in these companies, NSDL and CDSL. NSDL was a recent listing. It's a government-owned company, predominantly government-owned company or quasi-owned company, which is actually maintaining the accounts for the clients. This is, again, huge network effect. You can play the capital market theme through these companies. Or say, for example, the exchanges. These are also listed in the market and which is also not exorbitantly overvalued. But you can see that these are all can compound 15% CAGR for many years. Same way for when you look at quick commerce or some of the names like Eternal, these are all listed companies where the team is very bullish and we evaluate it from the right metrics because these are all not traditionally comparable relative valuation game that you can play because neither it is available globally nor it is available in India also. So maybe Swiggy and Eternal you can compare, but you cannot compare with any other company across the globe. Maybe China has few examples, but the construct of the market as well as the way the companies are positioned are also very different. So when we look at it, we generally, it's a new age business, we look at on its own merit whether the company is making in one line of business, whether it's making profits, is it established, is the first mover advantage, is a skin in the game, the various things we ask and we see that is it displaceable and see comfort in that positioning. Because we have seen companies like Amazon, for years together in US also, has not made money and then eventually started making money. So there are powerful companies like Eternal and all has come and listed. So we are evaluating it. We have to bring all these things into our investment process, which is what Saurabh and team is doing, so that we don't miss out some of the big opportunities or multi-bagger opportunities eventually, which we can become. At the early stage itself, evaluate, make our own framework, make ourselves comfortable, and build it into our portfolios. So that is part and parcel of the whole process that we undertake in the research.
So let's talk about something more topical, right? Tariff wars. And Amit spoke about that, almost dismissed it, saying, look, I don't think at this point of time it's a big concern. Are our portfolios tariff-proof in that way? Are especially liquid markets, are they so tariff-proof? Would you say that? If not, what changes you think you would need to do over the period of time to see how these tariffs play up, especially if our portfolios are going to get, some of the portfolios going to get impacted. So your views on that would be great.
So it's an interesting time. So, since I've been in the market for quite some time and started investing personally in 1991 and, as a professional fund manager and investment manager over the last 23 odd years, what I realize is that, there will be a lot of noise period in the market. Now the noise period is mostly the tariffs. So people all get perturbed and, every media and every aspect, everyone asks about tariffs. But if you look at and dissect and see that what is the impact that India will have and also the portfolio companies will have. Fortunately, for our sake, from the ASK positioning point of view, especially in the last 4 months back, when I joined in and, when we looked at the business cycle we want to play are more domestic-oriented sectors. As I mentioned, it is mirroring the 2000 to 2010 decade, which is what, we wanted to play. It comes with banks, real estate, capital goods, engineering, and these sectors which are more domestic in nature. That is what we have positioned ourselves for. And we restructured our portfolios to bring these companies into the portfolio and these sectors into the portfolio. So when we heard this tariff war, actioning to 50% tariffs, it is not going to materially change the course of things, and it is going to be, we analyzed, and it is hardly any impact to our portfolio stocks. Because where are we overweight? We are overweight on domestic consumption stories, which is more of GST beneficiaries, and rather than to the tariff exposed sectors like IT or sectors which are more to do with the exports, manufactured exports that we are doing from India. So when we looked at, we said more domestic oriented sectors, the positioning was right. In hindsight, it was looking more that we were positioning for not a tariff excluding portfolio, and plus we were positioning for GST benefits. So it's icing on the cake when we heard that the GST cuts were coming. So the portfolios are well poised for playing the GST benefit theme. And when I see all these noise of tariff, all these things will die down, as Amit was mentioning, in some time to come. And probably people will shrug it off and say that, okay, this is not impacting India in many quarters, unless otherwise the Hire Act come in and some sort of complete disruption in the IT services industry, or the manufactured exports. Further, it creates a balance of payment issue. I don't see it's going to make a material difference to the portfolios or the markets. So it's more of a near-term noise, which is, its noise is too much of a noise, because of the tweets are happening on a daily basis. So, but, I think we are well positioned to handle that.
So we should continue sleeping when the tweets are coming in, is what he's saying, which is good. Now look, whole day we've been speaking about India Rara, right? Everything's great, hunky-dory, best place to invest. And we truly believe, and we would want you guys to invest. But also let's talk a little bit about risks. Let's talk a bit about challenges that one sees. Fiscal deficits, current account, political instability, anything. Anything that keeps you guys awake. And I'd like to hear from both of you. Can't be the same. You both can't be remaining awake for the same thing, all right? And then we'll pass it on to the floor. But
yeah, Saurabh,
what keeps you awake? And let's also educate our friends. Yeah, India is great, but also be aware of the risks. And we are aware and we are managing those risks in that.
So apart from the ones which you mentioned, like fiscal deficit, BOP problems, which is currency deficit, the one critical thing which has differentiated India from others is the execution of Indian companies have been far superior in last 2 decades or so. India is historically been always the bottom-up market. So anything, if this execution ability of the promoters, entrepreneurs, of the management, given the tailwinds, and if we just try to just loosen up, like, okay, we are like in a great situation, things are going to do well only. If we miss on the execution, we miss everything. That's, I think, something which we need, especially from the research side. We need to be on top of each and every investee company from a bottom-up perspective. Tailwinds will always be there. Tailwinds have always been there. But historically, globally also, you've seen any company which miss on the execution side is never able to recover. So we would be very, very watchful for that.
So Samir, you touched upon some of the points, which are very critical. So over a period of time, if you look at the critical crisis, like the biggest crisis period in which Neelkant as well as, KB Kamath spoke about, the crisis that we saw on the balance of payments as well as current account deficit, fiscal deficit. If you look at the period like 2011 to 13, it was a mayhem, right? So I had the opportunity to launch a small cap fund during that period. in one of my previous stints. So the question the investor was asking, one of the large investor, ultra HNI client whom I went and met, he said, everything what can go wrong is going wrong. And then you are telling me to invest in small caps. What do you mean by that? Right? So the current account deficit was high, fiscal deficit was high, inflation was in double digits, and interest rates were high. And the Prime Minister Modi ji was not appointed as the Prime Minister. The election was in the offing. The RBI governor, one of the best governors whom we had, Mr. Raghuram Rajan, he was not appointed as the RBI governor. So if you look at, and plus taper tantrum was going on. So what not, everything what you can think of going wrong was going wrong. Currency was going through a tailspin. INR was depreciating against US dollar. That was a scenario. And that was the point where the valuation was the cheapest in the history of the markets. So large cap, mid cap, small caps, one of the lowest point in history. So that is the best point where you can invest in India. So when I look back, what are the risks that we can have from here on? One is today, for example, we are having only less than 3% as the current account deficit. You are having fiscal deficit of 4.8%, which government is thinking to bring to 4%. But at the same time, the oil shocks can derail the whole thing because 20% of the import bill is oil. If suddenly the oil price shoots up for some geopolitical reason, it can change the entire dynamics. Second, if you can think of, then the current account deficit problem starts and the rupee start depreciating and so on and so forth. Fiscal deficit, again, if the spending has to be high from the government side, which last 2 years it has been low, even though it was fairly large spending government did, but nevertheless, it was low compared to the past in terms of percentage increase and so on and so forth. But still, if the spending has to be high, then the fiscal deficit will go high. And some global headwinds, like what Nilkant expressed, his views that US dollar can depreciate by 30% or 40%, and which is something very similar to what we saw in 1985 to 87. US dollar depreciated, the Plaza Accord and US dollar depreciating against Japanese yen by 50%, which we saw at that point in time in 2 years. Something of that sort, it happens, to deflate the debt levels in US, that could pose as a big risk suddenly, and, maybe safe haven status everyone will seek. But, that will become a big opportunity for you to invest more. So all these, most of the risks, and again, I went back and explained, the 3 decades and 3 different cycles. If you look at every crash, in 2000 crash and 2008 crash and 2020 crash was mostly driven by US, right? So dot-com crash and also the rallies also has been supportive. So probably the risk is coming from these kind of global events rather than, as Saurabh spoke, is a very pertinent point because we are betting on growth in companies and the companies have to deliver growth, because many of them are trading at high valuation and it is to support that growth, to support that valuation, definitely the growth is expected from them. And the moment, the growth starts slowing, probably the companies get derated, the stocks get derated. So that's where the biggest derating risk is something which I have seen many fund managers go through, when you bet high and it didn't happen the way you thought, right? So we have at our investment framework, we have put an investment risk framework very clearly suggesting that, what kind of additional valuation comfort that you need to have. We call it as margin of safety. How the margin of safety is assessed is well thought out in the investment framework. So risks are mostly, in my mind, more global risk because the fiscal is well controlled, political stability is in shape. Now, all of a sudden, political instability arises, because of elections and so on and so forth. That is something which comes in the, again, as a surprise again, that becomes an opportunity to invest, Samir. So if you look at all the points where, big sell-offs have happened, and because of political instability or maybe balance of payment risk, those were the best times in history to invest. So I don't worry that India ultimately, as Amit also expressed, that bad governments 8% CAGR growth and good governments 12% CAGR growth, which is very relevant in the Indian context.
So as George said, that a lot of news emits from US. The way he sleeps best is he switches off CNN and he can sleep well. That's why nothing keeps him awake. Well, thank you. Thanks for that.